This is your 2 minutes on the markets with takeaways from my mid-year outlook. We expect the Federal Reserve to be on an extended pause through year-end, but acknowledge that the risks of a rate hike have risen. High inflation and the recent strength in the labor market would support the case for a hike, but there's a lot of uncertainty around that outlook. That doesn't mean the next move will necessarily be a hike, however, and we think the Fed will likely take a patient approach given all of the uncertainty in the Middle East. We expect the 10-year Treasury yield to hold near its recent 4% to 4.5% range, and we see more upside risks than downside risks. Sticky inflation, budget concerns, and the trend in global bond yields could all pull the 10-year Treasury yield modestly higher. For the 10-year Treasury yield to move meaningfully lower, we'd likely need to see economic growth slow and recession risk rise, and that's not our base case. With that outlook, we suggest investors favor a below benchmark average duration. Now is not the time to aggressively be considering too many long duration investments given the risk of modestly higher long-term yields. That doesn't mean investors should only focus on very short-term investments either, as there is an opportunity cost there. With a positively sloped yield curve, investors can earn modestly higher yields with short and intermediate term maturities compared to very short investments like Treasury bills. With a resilient economy and strong corporate earnings lately, investors can consider taking a little risk today, depending on risk tolerance, of course. We encourage investors to focus on the yields that they offer rather than potential price appreciation, and be prepared for occasional bouts of volatility. That's your 2 minutes on the market. Thanks for listening.